Meta just reported its fastest quarterly revenue expansion since 2021, a massive 33% surge. And what did the market do? It immediately tanked the stock. Wall Street looked at a single terrifying number, panicked, and left one of the most profitable companies on Earth trading at a steep discount to its actual cash-generating power. Today, we're figuring out exactly why the market's visceral reaction to the price tag of Meta's Moat is masking a brilliant strategic execution, and why this specific tension is creating an undeniable valuation gap.
That single number triggered a massive 8.6% drop in Meta's stock price right after their earnings report. The main culprit? Wall Street caught a sudden, severe case of Capex fatigue. Investors saw the massive bill for Mark Zuckerberg's AI infrastructure ambitions, assumed the absolute worst for near-term margins, and aggressively hit the sell button. But we're going to unpack why this specific panic completely misses the bigger picture. We need to look at the actual cash engine driving this business, the operational reality of their spending, and why this exact market disconnect creates the valuation opportunity we're exploring in this explainer today.
Just look at this sheer disconnect. On one hand, you have a brilliant 33% revenue beat. I mean, the core advertising business has rarely looked healthier or more dominant. But on the other hand, you have this terrifying $125 to $145 billion capital expenditure guidance that just thoroughly spooked the street. The tension here is palpable. Is this a tech giant recklessly burning cash on unproven AI infrastructure? Or are they intelligently funding an unassailable digital fortress that competitors simply won't be able to afford to breach? Well, to answer that, we first need to understand the fundamental economic engine that's paying all these massive bills.
3.56 billion. That is the number of daily active people across Meta's ecosystem. Think about that for a second. This isn't just a large user base. It's an unmatched compounding network effect. If you're a global enterprise brand or a small local business, and you want to reach half the planet's population every single day, you effectively have one choice. This unprecedented scale gives Meta absolute pricing power over digital advertisers. It creates this relentless, closed-loop feedback system of first-party consumer data. Every scroll, every click, every second of attention trains their algorithms, driving a return on ad spend that competitors literally cannot replicate. They own the most valuable digital real estate in the world, and they charge rent with ruthless efficiency. When you peek under the hood, you see exactly where this cash comes from. In the first quarter, the family of apps, Facebook, Instagram, WhatsApp, Messenger, generated nearly $56 billion in high-margin revenue. Now compare that to the tiny $402 million from Reality Labs. Despite all the persistent headlines and noise around the metaverse and VR, the core social apps remain the undisputed moat. They command an incredible 48% operating margin. Nearly half of every dollar that comes in through the core apps falls straight to operating profit. And that cash cannon, it funds absolutely everything else the company attempts to do. But let's not dismiss that hardware segment entirely, because while Reality Labs operates at a multi-billion-dollar loss, Meta has quietly executed a masterstroke in spatial computing. They've secured an 82% global market share in smart glasses, shipping over 7 million of their Ray-Ban units in a single year. They are dominating this category completely under the radar. By partnering with a legacy eyewear brand, they actually solved the aesthetic problem that killed Google Glass a decade ago, establishing a massive distribution lead and setting the consumer standard well ahead of Google's anticipated entry into the consumer AI smart glasses market later this year. So the crucial question becomes, if the core advertising business is so phenomenally strong and they're already winning in early hardware distribution, why the absolute panic from Wall Street? Well, enter the central conflict. $238 billion. That is the staggering sum of Meta's locked, non-cancelable compute commitments for data centers, custom 2-nanometer silicon co-developed with Broadcom, and global network access. This is the bill for the AI war. The market fears this unprecedented infrastructure spend will severely compress near-term free cash flow, inflate depreciation schedules for years, and permanently destroy the elite operating margins investors have come to love. And by the way, if you like deep, evidence-based stock breakdowns like this, make sure you're subscribed, because here is the powerful counter to that Wall Street bear case. 22.9%. That is Meta's elite free cash flow to sales conversion rate. Over the trailing 12 months, this business generated over $57 billion in pure free cash flow. So they aren't borrowing heavily at high interest rates to build this AI infrastructure. Their core advertising engine is so wildly profitable that they're funding this entire $145 billion capital expenditure budget essentially out of pocket. They are cash flowing the construction of the world's most advanced data centers. The hard evidence from their late April earnings report proves this balanced global strength. Ad revenue didn't just grow in one specific region, it surged everywhere. In Europe, impression volume grew by 17%, while the average price per ad jumped 19%. Worldwide ad impression volume surged by an incredible 19% year-over-year. Meta's generative AI tools aren't just a science project. They're actively automating copy and design for over 8 million advertisers right now. This lowers the barrier to entry for small businesses, boosts conversion rates, and drives massive pricing power across the globe.
So how does this translate to the bottom line? We have to be intellectually honest here and read the fine print cleanly. Meta reported a staggering GAAP earnings per share of $10.44. However, that number was heavily inflated by an $8 billion one-time tax benefit regarding capitalized R&D costs. But even if we strip that tax benefit out completely to see the raw operating reality, the adjusted underlying EPS was $7.31. That adjusted number still cleanly beat Wall Street's expectation of $6.65 by nearly 10%. The underlying business is firing on all cylinders, regardless of the accounting noise.
This brings us to management's specific strategy to protect profitability amid this massive spending cycle. CFO Susan Lee made it explicitly clear in the Q1 commentary. They are balancing this historical infrastructure build-out by keeping a strict, unyielding lid on human capital. After laying off roughly 10% of their workforce and closing thousands of open roles, they are holding steady at about 78,000 employees. This rigid discipline, established during Mark Zuckerberg's year of efficiency, is exactly how Meta defends an elite 41% overall operating margin while simultaneously building the largest artificial intelligence supercomputers on the planet.
So how do we synthesize the quality of this business? Based on the detailed qualitative scorecard, Meta commands a highly impressive blended score of 8.5 out of 10. We see a perfect 10 for market position and profitability, completely justified by their 3.5 billion daily users and immense free cash conversion. We do, however, dock points for management alignment, scoring a 6, because Mark Zuckerberg holds 61% of dual-class voting control, while only holding a 13% economic interest in the company. That structure means minority shareholders have no real voice. We also have to acknowledge Reality Labs as a cumulative $90 billion cash drain. But overall, when you zoom out, the enterprise is an absolute fortress. All of the research behind this explainer was created using Flash by StockSentinel.ai. You can generate deep research reports like this one for any public company in the world, completely free at flash.stocksentinel.ai. The core company research is totally free. If you want an ongoing investing edge, Flash has a premium feature called Best Ideas Now. Every week, it surfaces the highest conviction ideas across 3 investors' styles: long-term compounders, hidden gems, and dividend hunters. Premium also includes Portfolio Watch to monitor your portfolio for important changes, and Insider IQ to track meaningful insider buying activity worldwide. You'll see a QR code in the bottom right of this video. Scan it to download the Flash app and try it yourself, or access Flash on the web at flash.stocksentinel.ai. Pricing is going up over time, but once you lock in your subscription, your price never increases.
Okay, let's get back into the core numbers with our 5-year scenario framework. Before we dive in, I need to state this clearly. This is a hypothetical framework for thinking about possible outcomes. It is not a prediction, and it is not financial advice. The stock could go much higher or much lower than any of these scenarios. What we're doing is evaluating potential future share prices based on strict operational assumptions, anchoring directly from Meta's baseline operational results against the current $646 share price. We're looking beyond the next quarter and focusing on what the fundamental business can deliver over a half-decade. Here's exactly what the math reveals across 3 distinct scenarios over a 5-year horizon. In our low case, the stock drops to roughly $480, representing a negative 5.7% annualized return. Our base case implies a share price of $1,163, netting a healthy 12.5% annualized return. And our high case points to just over $2,010 per share, or a massive 25.5% annualized gain. The true value of this framework is that it moves far beyond simple PE multiples. It looks at the operational scale required to achieve these valuations. Let's break down the precise operational logic of the most likely path, the base case. For the base case to unfold, we assume a 13% revenue compound annual growth rate, bringing top-line sales to roughly $370 billion in year 5. Operationally, this is highly realistic given steady global digital advertising TAM expansion and Meta's AI tools, like their $20 billion value optimization suite, successfully increasing ad pricing power. This efficiency allows them to maintain a resilient 40% operating margin, entirely offsetting the heavy depreciation costs from their new data centers. Furthermore, we assume those massive free cash flows allow aggressive, continuous share buybacks, systematically reducing the outstanding share count to 2.38 billion. Apply a very reasonable 22 times exit price to earnings multiple to that future earning power, and you arrive at that $1,163 target. When you assign a 55% probability to the base case, 25% to the high case, and 20% to the bear case, you get a probability-weighted target of $1,238.64. The thesis here is incredibly straightforward. At the current price of $646, Meta is trading at a trailing PE of around 24. The broader market is thoroughly pricing in the terrifying, immediate cost of the AI infrastructure, but is deeply undervaluing the long-term cash-generating capability of this 3.5 billion user network over a multi-year horizon. The moat is expanding, but the market is only looking at the construction bill.
But what if the market's initial panic was completely justified? We have to pivot strictly to the bear case, because the risks here are not trivial. The single biggest execution risk is an AI monetization failure. If that $145 billion infrastructure budget doesn't eventually yield massive, quantifiable advertiser returns, Meta faces catastrophic multi-billion-dollar asset write-downs. Competitively, Google's planned entry into AI smart glasses threatens Meta's early hardware distribution dominance. And regulatorily, we can't ignore the FTC's ongoing antitrust appeal carrying existential structural breakup risk, or the European Union's Digital Services Act probes that could literally result in fines of up to 6% of global annual turnover.
As an investor, you don't just passively worry about risks, you actively track them. Here are the specific early warning signs to watch for that would fundamentally break this bullish thesis. Look for a sequential contraction in return on equity. Watch closely for a loss of ad pricing power, particularly in the premium US and Canada markets where they generate the most margin. Pay acute attention to macro energy grid limitations capping their data center expansion. These AI chips require immense, unprecedented power, and grid constraints are a real threat. And finally, if Reality Labs' losses ever force Meta to suspend their share buybacks or newly initiated dividend programs, the core financial thesis is structurally impaired. Let's bring this all together and synthesize this story. The market panicked over $145 billion Capex bill, momentarily blinding them to a company that just posted a magnificent 33% revenue surge. The reality is, Meta's core advertising engine generates so much free cash that it can easily fund its massive AI moat without breaking a sweat, all while holding headcount perfectly flat to protect margins. Moving forward, the single most important thing to watch is the upcoming earnings report for any signs of Capex stabilization. The initial panic simply masks the true, compounding, and undeniable value of the business. If you want the full research, including the deeper framework behind this explainer, you can get it free at flash.stocksentinel.ai. Until next time, do your own research, and I'll see you in the next one.
Check out Flash at flash.stocksentinel.ai to access free research and videos like this one for any company in the world.